Ladies and gentlemen of the crypto space, we're live on a Monday, April 24th at 11:31 a.m. April 24th. Put time into perspective. Where are we in the year? Where are we in the cycle? Where are we in multiple cycles? Where are we in the decade? It's the 23rd. We're not even halfway through the decade. Put this in the consideration of time horizons. And you're going to find that most people have a 5-second time horizon and no scope of context of where that time horizon fits into the overall systemic flow of capital in these systems and the whole macro conversation that we have. The only way to traverse and survive these markets is to have that contextual information to provide that perspective to know where we are in the cycle of cycles. Otherwise, how are you supposed to be comfortable? Right now, you see markets going down. Last week, they were going up. Were they supposed to ever go up? Does it matter if they went up or went down? All that matters is the state of liquidity. All that matters is the flow of liquidity. All that matters is understanding the potential for liquidity to return. When? From where? How? What conditions? Conditions tell us path, and these conditions suck. Why? Because the liquidity conditions are dry. It's parched. I don't give a crap what meme shit some noob is buying. And in fact, that is exactly the point of the stream's title. This type of market breeds desperation, not just from predators, but also prey. It's minus 1.5% over 7 days on Mainnet. I mean, I remember this was at like 73 billion a month ago, 2 months ago, whatever. What at 1.51%? Negative sum game on Mainnet? Do you want to see Arbitrum? Your hot chain with the Arb airdrop. 5.25% drain of liquidity over 7 days. On April 23rd, yesterday, $29 million came off the network. Do you know why it came off the network? Because someone transferred a couple $1,000,000 over to the chain, played around in the playground, turned that couple of $1,000,000, turned that $3 million into $5 million, and took their money off the L2 and brought it back to Mainnet, where there's guaranteed finality and you don't have the exposure of the L2 multisigs and all that controversy. It's right there in the chart. That's why the capital flows out, because the big money flowed in and capitalized on the little tiny rabbits, the prey. You need to think like a predator. You need to think like someone who could throw around a couple $1,000,000 on an L2. And that's what they're going to do. They're going to take people's money. And that's not even the meme coins. That's literally just capitalization from, like dominating an LP position or just overwhelming a market, a relatively low market cap asset. Gives you great power to capitalize. More money is easier to capitalize. And the meme coins are even worse because that's just either they're straight up scams where, for instance, it takes a minute to publish a coin. I could publish a coin in a minute, and you throw 50 grand worth of liquidity, USDC paired with some bullshit meme coin that you publish in a minute. You own the liquidity. You own it. You are the coin. So what's the point of these meme coins? Nothing. It's completely adversarial. And the person who created it took a minute and deployed a couple of bucks, and now they just have legal concerns and anonymity concerns and how they're going to manage their likely ill-gotten gains concerns. And that is the type of environment this is. Does anyone not remember ICOs of 17, 18, and 19 and 19? It was just getting desperate. It was a ghost town. This didn't exist in 19. You didn't have these stable coins in 19. This is a very different environment. Now, the ICOs don't need to be like, when Binance? You remember that shit from 2017, 18, 19? When Binance? When Bittrex? When Coinbase? When launch on exchange? What kind of fucking bullshit was that? That was such a laughing stock back then. At least we don't hear that narrative now. Some unknown coin. When is it going to get listed on an exchange? At least now we have Uniswap and other permissionless exchanges. So it's not that silly narrative we all should recall. And if not, understand the prevailing mentality that created that narrative. Everyone's like, I hope my coin, my bullshit coin, is popular and is available to purchase so other people can buy my bags and I could profit during a time when liquidity is draining in the markets. There's not going to be opportunity in these markets. There's not supposed to be. This is a market that's defined by the concentration of liquidity from the many to the few. The many that have small amounts of capital to the few that have large amounts of capital. Just like physics and gravity accumulates more and more material. Financials have that metaphor that is overwhelmingly suited. Capital attracts capital. So don't succumb to the bullshit of this negative sum game and draining liquidity environment where people, especially the inexperienced, are susceptible to manipulation by strong, powerful predators. Strong and powerful meaning the amount of capital they wield, or even the ingenuity they wield. 50 grand and 5 minutes, and you push a contract, and you own the liquidity. And boom, before you know it, the liquidity, 50 grand, and it's Pepe, and it turns into an $80 million coin. So some dude, nothing's going to turn out well with that shit. Nothing's going to turn out well with that shit. It's like, it's capital gains. It's the same thing whether it's bullshit or legitimate. And that's why I can't stand growth equities. And I can't stand anything that has a growth narrative. Buybacks. Some bullshit narrative for engaging with the markets. There's no value in it. It's just everyone's putting their money in the pot in the center of the table. You don't want to pull it out. You want your money in the center, so you put your money in, and you're like, more people. Okay, good. More people are putting their coins in. More people are putting their coins in. Oh, it's slowing down. Less people are putting their coins in. All right, I'm taking mine out. That's capital gains. It's the first to pull their coins out of the pot. What kind of baby back bullshit way of engaging with markets is that? Are we animals? I mean, the answer to that is yes. Can we be a little bit more strategic, a little bit more depth to the way we potentially handle financials instead of some primitive game? That's what it is. A picture, some sort of like wildlife documentary. I mean, that's what these humans are, us. And the less experienced engaging with stuff like a Pepe coin. It's like literally you could put a documentary on some wildlife channel, like, the rabbits are going after the llama in the center of the field, and the lions are circling. There's some wildlife bullshit going on. But it happens time and time again, cyclically. Humanity is cyclical. Time rhymes. It doesn't repeat, but it certainly rhymes. And humans will behave like humans, animals. Dan's in the house. Crypto Twitter seems incredibly bearish all of a sudden. No, it was always bearish, bullish. Take that word out of your repertoire. That word will drive you nuts because it implies certainty. It implies the state of a market that is nuanced, that has flavors and rhythms, up, down, directionality, certainty. The best perspective to have on markets that give peace of mind is pressures. Pressures. You can have a positive pressure, but things are moving in a negative direction, which is why some folks say this is a bullish depreciation or a bullish move down. Folks have probably heard that type of talk before. There wasn't enough pressure. There was a positive pressure. Maybe you see 1% flow into Ethereum mainnet. It goes up to $72 billion, $71 billion, but you still see things depreciating because there wasn't enough positive pressure in the market. Pressures, conditions suggest path. The pressure suggests path. Pressure is a condition. They suggest the path. They don't tell you the path. Bullish and bearish narrative will drive you nuts. Good morning. Hey, Asun. Pepe. Dan, bringing up the prime bullshit that is circulating in markets. I haven't done anything in the market since, a bunny position? And this was like a couple months ago at this point. Sure as hell took out a lot of cash to pay taxes. Set up a couple of trips for me and my family a little later this year. Cashed out a little bit for that. Have enough cash, at least for this year. And that's not even considering cash flow. I expect to get significant cash flow over the course of the year. I expect the cash flow to decline. I expect the enterprises that I've chosen to remain. I've never been exposed to a failed protocol since all of this market started in late 2019, early 2020. I'm the conservative guy, and I never had a rug. I never had a failed protocol. I dabbled in failed protocols, but I was out before they even remotely failed because I just can't stomach the risk. I can't. I just can't take it. I can't sit overnight in a liquid position, and I will underperform the markets because of that. But the folks that listen to me, you're going to survive, and that's really all that matters. Because if you survive and you persist in a market that's able to retain capital, sticky goddamn capital, an emerging market that has $130 billion. That's crazy. Do you realize what this chart is? This chart is like a country that planted a flag in late 2019. Pick a place on the damn planet. They set up an economy in 2019, and way more at the time, the total amount of capital that flowed in, but dollar units of account flowed into this country. 3 years later, that country has retained $130 billion worth of the global currency supply, either in proxy currency units, a USDC, or a euro-dollar unit, which is an extension of a liability, the manifestation of an abstract currency unit. In one way, shape, or form, these are currency units that are not allocated to other markets, that have not flowed to Indian markets, that have not flowed to Asian Pacific markets, or Chinese markets, or European markets, or U.S. markets, or African markets, or South American markets. They're here. On the screen, you're seeing them. That's crazy. And you're out here chasing fucking Pepe coins and other bullshit. Just survive. Survive in infrastructure shit that allowed this to occur. This is the most profound goddamn thing I've seen of any market. I mean, sure, you could have the narrative of Tesla back in 12, their Model S, starting to disrupt the legacy manufacturers. And I myself participated. 2015, I had my first car from Tesla. And now there's so many cars on the road. Over time, it disrupted the status quo. And all the other manufacturers are making electric vehicles. And the whole point is, it takes time for these structural changes to occur. But they stuck, very much stuck. And every manufacturer has an electric vehicle at this point. Every single damn manufacturer. And that's what this market is going to do to the planet. This market has retained this amount of capital through a draining global currency supply, of a sequence, a liquidity sequence. They say that the crypto markets have never experienced the crash conditions of '08. They say, what will happen? The liquidity is going to drain. Folks are going to sell shit. That's obvious. We see it. And it'll go down even more. But at this point, after 2022, how much capital outflow is forced selling? There's two types of selling. There's opportunistic selling, where capital flows from underperformance to outperformance. And then there's forced selling, where capital is required to be, where assets are required to be liquidated to take the capital out because it's needed somewhere else. 2022 was an exercise of, I got to get the fuck out. It is forced selling left and right, liquidations, bankruptcy, maelstrom. That was a torrential hurricane of an environment in 22. This is baby mode. This is like a sprinkle. It's barely raining outside. This is a relatively calm market. But expect this to persist until policy in aggregate changes in central banks worldwide to increase liquidity conditions. And it's all going to come down to what Luke Gromen talks about, balance of payments. At some point, every damn country on this planet cannot handle recession to an extent. Recession is a contraction of productivity, which is generally a decrease in GDP, which is a decrease in tax receipts, because every country has a debt burden. So, you have a certain amount of income, you need to have a certain amount of money in your bank account to pay your monthly expenses. It's a simple damn equation. So at some point, the central banks need to allow currency expansion. They need to allow or create an environment where credit is extended that allows enterprise to expand operations, that allows more sales, more purchasing, more financial activity, more tax receipts, because they need the income to pay the damn bills. And that's not now. They're still talking about, is there going to be another raise in May? There probably is going to be another raise in May. Higher for longer. We're not in control. They are. The only thing we have control over is surviving. Pick an analogy. You're on a surfboard and it's waves. You got to stay on the fucking surfboard. You got to stay and you got to survive. Because at some point, the favorable conditions will emerge. And when the favorable conditions emerge and you have survived, you're just riding the wave on infrastructure that survived. That's insane, because anything that survives this shit show is going to be seen as outperformance. And what does capital do when it sees outperformance? Capital flows from shit opportunity to survivors, from shit opportunity to things that have outperformed. And that's the stuff That is the infrastructure. Yes, you could go on the L2s and stuff is AVAX and Joe and GMX and the other stuff, smaller stuff, the options and derivatives and the other euro dollar platforms on the microscopic L2s. You're not necessarily going to have better outperformance on the L2s than you are on Mainnet. And I know it was 67 Gwei right now. You're going to have 30, 40, $50 transactions on Mainnet. But it doesn't mean you have to engage in countless transactions. I haven't done a transaction. I send things. I transfer stables to debit cards and shit like that. And those are like $3, $4, $5. Smart contract interactions are going to be 20, 30, 40, $50. But my point is, you take a position. You check back on that position in 6 months, in a year, in 2 years. There's no reason to hesitate over Ethereum mainnet transaction fees. You're not going to necessarily have a better experience on the L2s from an outperformance standpoint because you don't know where the liquidity is going to flow. As of right now, there is a much higher chance for greater potential return for your investments on Ethereum mainnet in the coming years because there's much more capital here right now. Capital will flow to where capital is. Just like at a concert and there's a group of 50 people and then there's a group of 3 people. More people are going to flow where the bigger group is, where the bigger booth is, where the bigger excitement is, rather than to the smaller group of people like, what the fuck are they doing over there? The analogy that you can draw between this market and markets in general and human behavior are very important to be critical of because it's simply that. Why is more money going to flow to Ethereum mainnet? Because there's more money there. That's it. Simple. Period. Done. So can you have a position that's meaningful considering a transaction fee, $50, $75, $100 to take a position? All right, so now you need X amount of capital to take a decent position size. A position size of what? Evaluate the protocols. I'm not here to tell you the protocols. We've talked about protocols for years. Folks know the protocols that I have interest in. Folks in our Discord have the protocols, the core protocols that we have interest in. All of those protocols have expressed survivability characteristics for one reason or another. It's going to be fun the next cycle whenever it comes because it will come. It's guaranteed to come. And everyone's going to be talking about the shit that's outperforming. And it's going to be the stuff that we've talked about all these years because it survived. And that's the simple equation. Stop trying to make money in a shit global economy. Geist and Blizz, Risky Crypto, how are you? Let me try and catch up with the comments. Good points between bullish and bearish. Can you please take a look at the FXS chart? Let's take a look at FXS. Oh yeah, look at that tragedy. Solid on mainnet. I don't know who saw that coming a mile away. I don't know. I don't know what to make on Frax. All I know is I don't know. I don't have an opinion from a technical perspective, unfortunately. From a fundamental, structural, narrative perspective, there's plenty to be said. Well, survival perspective, there's a risk profile. Um, there's a more of an attack surface. But it's such a grandiose narrative that hits on so many systemic systemic features of a financial market. That's really why. There's nothing interesting technically here. Maybe from a capital gains perspective, but like, what are you at, a support, at a long-term support, and where's the liquidity? I mean, there's 42 mil in liquidity, and where are you going to get? Where's 5, 6, 7, 10 mil of liquidity going to flow in to drive this to new highs? It's not going to happen in this kind of market. This is the type of market where you want to find infrastructure, shit that will survive. Then you could go out on the risk curve. This would be all further out on the risk curve as compared to stuff like a curve or a convex or some of the liquid derivatives, and obviously the derivatives of Ethereum. But this is where you want to find the cheapest price possible. This is your speculative investment in the future. If this infrastructure, if how big of a target of their next versions of their deployments, so that has overtones of an investment contract. So there's a complexity there. We're dependent on the iteration of the protocol. So there's a complexity there, most certainly. But it has shown survivability characteristics, and that's meaningful. So it depends how far you want to go out in your own risk curve. This is exactly why I talk about immutability, because then you don't have any of the attack surface, any risk profile associated with continued development or iteration. I expect things that are immutable to continue to exist and will outperform just because they're damn immutable. So complex considerations with regard to this. If I was thinking from a $3,000, $4,000, $5,000 portfolio, it's meaningful, but you're going to want to find cheaper, much cheaper. You're not going to get bang for the buck unless you've like there's serious capitulation and structural liquidity outflow, and this thing's getting you're buying basically this. If you want bang for the buck, you want to buy monthly. You want to buy wicks like this thing. Bitcoin, March 2020, Sunday, the 1st, wick down to 3,000 and change or whatever, upper 3,000s. And you want to look to the macro charts, Bitcoin and Ethereum, to see when there's some significant forced selling, significant systemic pressures from a structural financial system perspective. And then you could potentially find discounts on infrastructure type protocols. I mean, seriously, but the smaller the portfolio, the larger of a discount you need. You want this at like 250, 3. And if you can't get it, you can't get it. You got to find a different narrative. Because you need position size that's appropriate. Otherwise, you're not going to get anywhere. Albeit, you could get 500, 1,000%, over a couple of years. It's meaningful. Turn $1,000 into $5,000 to $10,000 in a couple of years. I mean, that can be meaningful. Everything is relative. It depends on a person's personal finances. Got to find a different narrative. Just respect the position size. If you cannot have an adequate position size, unfortunately, it does invalidate a potential position. Please remain rational. You might want a position, but you might not be able to afford a position. It's real. And don't ignore it, because it's self-destructive, possibly. Dan mentioned Geist and Blizz. That was an absolute spectacular tragedy that we all experienced, probably. I don't know how much money we lost over the years. All that 2020 money. It was just by the end of 2020, it was just all like flowing out, and the most bullshit speculative stuff we were playing around with. We were still trying to figure out what this is. What is it that we're experiencing? What is this market? What are these systems? What are these tools? What are the driving factors of capital flow? How this market that's emerging is able to attract capital. And now, 3 years later, we have a very meaningful story, and And it's attracting capital because these systems are indeed iterative atop traditional financial infrastructure. And notice that there's fewer and fewer protocols that have retained their value and have stuck around for one reason or another. Killis is in the house. Good morning, Raul, Asarco. Rational therapy for a Monday, especially in these markets, right? Tapsy's in the house. Cap, can you talk about the aura chart? Oh, look at aura. A couple of folks have been talking about finding entry points on aura. So, there's a couple of things in the works. The governance is this is one of the most active governance communities in all of crypto between this and Balancer. And that's meaningful because that means there's choices and decisions and participation, and that will result in iteration. The entry points are going to be dependent on potential portfolio structure and position size. In the end, in this market, you want cheaper. You want as cheap as possible. You're never going to catch bottoms. And I speak not from a capital gains perspective to get cheapness. I speak from a productivity perspective and the potential cash flow. So just remember the cash flow is not relative to its price point. The cash flow is relative to the amount of third parties that are participating in a capex deployment perspective for vote rentals. Oh, that's my revenue. Aura. And these are nice numbers. So a lot of this comes from transaction fee revenue and recycling, as well as capex of respective protocols that are trying to outperform the protocol and liquidity's recycling capability. So this is what will drive the bottom on this chart. But right now, the yield is not adequate on Aura enough to sustain the price point, so it's going to reprice to the point where people are like, oh, it's enough of a discount. Like, oh, now I can have a decent amount of return on the Aura position, and people will start to buy it eventually. You want cheaper, so strategies like DCA come to mind. I mean, small percentages, 0.5%, 0.5%, 0.5%, until you get, it takes it's like twapping in and stuff that Frax's TWAP protocol and other TWAP protocols or DCA protocols, and your target is like 3% of your portfolio. Like you have a 10 grand portfolio, 3 grand, that's 30%. $300, 3%. All right, fine. So with a smaller portfolio, you can't really allocate necessarily 3%. With a 10 grand portfolio, $300 positions are not necessarily effective. They won't work, especially on Mainnet. It's going to take you 50, $100 to take a position, and the position is going to be $300. You'll never be able to get over the claims. Hidden hand claims are too pricey. So that potentially does invalidate some considerations or a lot of opportunities on mainnet, albeit, or a balancer and their L2 deployment can expose some additional opportunities. I don't expect them to be as big as mainnet. I really would like to fast forward and see what happens with the solidly forks, with Theta, Velo, BSC, Optimism, whatever the hell is going on Phantom, Avalanche, Arbitrum. In the end, it comes down, these protocols, these currency recycler protocols are all completely dependent on third-party capex. So as the liquidity in the markets continue to drain, third-party capex deployment is continue to come down. You expect depreciation, and that presents potential opportunity. I could speak from my perspective, my portfolio size. I'm not too interested in what's going on the L2s. I'm more interested in mainnet. But my perspective is biased. It's relative to me. It's subjective. increased risk profile associated with the L2s can achieve increased outperformance in the coming years. And I might miss out on that opportunity. But as I always say, my risk considerations basically dictate that I will underperform, and that's okay. Just think from that perspective. Be considerate of that when I talk about particular protocols. Anything I say does not invalidate the narratives for L2s. Just because there's an increased risk profile and I don't allocate to them doesn't mean there's also opportunity that I might be missing out on. Just as long as you define it for yourself, your risk profile. I am taking this position because of this. It is a decent position size. What kind of returns could I expect from this position on a weekly basis? Or as a 4-month lock. Maybe there is going to be outperformance in the coming years, and it's $16 and you made 400% on the Aura position, and the entire time it was printing 30 to 50% a year. Okay, so maybe you have enough capital for that equation to make sense. You deploy $4,000 and it's worth 16 grand in 2025, 2026, and it was producing $2,000, $3,000, $4,000 a year for 3 years. All right, maybe that equation is decent, and you come out with a $4,000 deployment. You come out with 20, 30 something $1,000 in a couple of years. Maybe that equation is suitable. But run the equation, run the projection, run the speculation, run the numbers, and assess if it meets your expectations. One of the hardest things to do in markets is to meet your expectations, to avoid disappointment. Define what will be a disappointment. Define what will be a success. Define your goals. The hardest thing in markets is to accept disappointment. Am I disappointed with my portfolio? Yes. Should I be? It's relative. It's done very well, and I should be appreciative. And that's a very hard thing to learn in a market where there's FOMO, where there's all these emotions running around of people turning $250 into $1 million on stupid Pepe bullshit. That is not the average. That is the few, and the vast majority lose everything, which is why I harp so much on the concept of surviving. Joe, you used this. There's more capital in Ethereum, therefore more likely upside for your solidly narrative, but Velodrome is the only solidly fork that has developed the proper federation to sustain itself. That is correct. So solidly Mainnet is currently failing because it doesn't have capex to finance vote rentals. What's needed is a significant restructuring of how the protocol operates. It always needed to recycle transaction fees, and that's really what like protocols like Bunny are doing. We go over to markets, you go over to Bunny. They're recycling their transaction fees. So as transaction volume, if transaction volume picks up further, there's going to be more capital to deploy here. And also the OLED sales is also another potential capex or capacity to deploy capex because there's more income from that. And that's just an observation I've had over the years of why those systems, why these currency recycling regimes, which are extensions of curve finance, how they work, why they work. Cyclical currency flow, currency velocity. The narrative is all throughout traditional finance. They talk about M2, and they talk about M2 velocity, and we talk about, foreign exchange and the DXY and the availability of international liquidity and bond depreciation and juicing international liquidity conditions as the bond prices, the collateral prices come down, allows people to print dollar-denominated currency units, euro dollars overseas. And all of that macro talk we talk about helps us define the systems that are more likely to succeed here in the crypto markets. Now, Velo's done well predominantly because they have a large amount of OP. for CapEx. Meaningful. Longevity, what's the sustainability, what's the time horizon? It may be meaningful and it may work. For how long? What's the future? We have no idea what the damn future is. But if you go over here, what do I know quantitatively today? Optimism barely registers from a liquidity perspective. It's just basically zero in global liquidity. This is nothing. It's $667 million. This is not even a nation. This is not, it's a small business. And that's the network, on the protocols on the network. How much fluid flowed out? Let's see this candle. April 23rd. Yesterday, 8.9, 1%, over 1% flowed out. So, big money. 1%. Someone capitalized $1 million. It's one, two people that are making $1 million here and there. It's the big actors with the large capital, capitalizing on the small prey. So if you're small prey, if you have a small portfolio, operate with that in mind. You are small. You are a rabbit. You are going to be taken advantage of. Someone is going to try and take your money. So what's the narrative there? What is it? I forget the name of the shark. Shark with small. Oh, the remora fish. The remora fish. The little guys. So they're these. Look, this is a perfect image. Please, if you have a smaller portfolio, this is biologically what you're doing in financial markets. You are hanging out with sharks. And yes, you can be on the right side of the narrative. You can chill with them for. I want to see this video. That's, all right, maybe not. But there's a lot of. You see how many little small ones. That's a great picture. There's hundreds of small little fish attached to the large shark, or the stingray in this instance. But it's a biological comparison. Most predators are not going to let this happen in financial markets. Humans are much more aggressive than animals. Hilda's in the house. Pleasure. How are you? What's up, Noah? Rupert. What do I think of Popsicle? Wag me now. No interest whatsoever. Um, Hayes. I want to circle back around to his article again. I want to read it again. But his content is usually very meaningful. He's got a lot of capital. He has a lot of assets. You cannot engage with markets like the large actors. Even I can. I'm nothing compared to the large actors. Folks running around with $500 million. Very different considerations. Basically owns GMX, one of the largest actors in GMX. It's a different equation when you're able to dominate a protocol. When you own a significant percent of a protocol, you are few. You're part of a small community of owners. And it just so happens in the crypto markets, these enterprises are relatively small. In traditional finance, I mean, what does it take to own 30% of ExxonMobil? You're a Buffett. It's the few that can own a large percent of an enterprise. But when you own a large percent of an enterprise, you have a different equation. You're very much aligned with the success of the protocol. You define the future of the protocol in many regards. Because if you decide to allocate to something else, that's going to significantly alter the trajectory, especially the liquidity conditions of the particular protocol and the asset, its pricing, so on and so forth. Athena on Binance cranks around 200%. Yeah, but it's BSC. So the problem there is I can't stomach exposure to that network. The regulatory climate and I just can't. $6.42 billion. Look at this liquidity. It's flat. It's dormant. It's still a microscopic chain. There's more than 10 times the liquidity in Ethereum mainnet as compared to Binance Smart Chain. $70.46 billion, six and change billion dollars. So, but six and change billion dollars is meaningful. Relatively cheap transaction fees. Just remember to take your gains, your revenue, and bring it to a safer environment where you can have a better chance of protecting your capital. And that's what we want to do. That's how you survive. You protect yourself. Risky crypto Pepe. Oh my God. Kill us. I just noticed the halal section on DeFi Llama. Really? Hacks? DeFi Llama has some of the best information there really is. Aside from the swap, oh my God, their swap is just so good. A Dex of Dex, a meta aggregator. What a lovely system that they built over the years. What was the original? Well, DeFi Llama came after DeFi Pulse. This was hot for a while back in 2020. You remember this shit? This clearly went nowhere compared to holy shit, this. This is such a source of information. Huge amount of information. It's under yields. There's a halal section of yields. How do you like them apples? Well, that's considerable from a global financial landscape and what cultural considerations there are in allocating capital. LP. Can you please talk about the new Frax baseball LP? This is why Frax is such a hard topic from a risk assessment standpoint. Frax is trying to take over WETH, and it is positioned to. STETH, RETH, and the other small wrappers, liquid staking derivatives, are not equipped to do it. But Frax has the capital availability from its revenue, from its protocol and liquidity, from its stablecoin activity, from its growth of FXSETH. It's in a position to do it from its connections and CVX and curve that it owns, its governance, weight that it can throw around to approve governance activity vis-a-vis convex or directly with curve. And it's able to restructure liquidity significantly in the crypto markets. That's just such an extraordinary power. It's literally redefining base pools. So I don't even know how to assess that risk profile. I don't, because it has such a large regulatory target on it. But you go over here, look at this shit. Holy shit, they are just throwing around base pools all over the place. They've redefined liquidity, the structure of liquidity, in such an extraordinary way. And the USDP, talking about swapping out USDC, and maybe USDC isn't too much of a problem necessarily. That we'll only know in hindsight how much of a problem that turns into, if it turns into a problem at all. I don't know. But these are the risk considerations with how you structure your exposure. But we do know that Frax is a meaningful component of the structure of liquidity in all of the crypto markets. The amount of capex they throw around, their ownership of convex and curve, it's quite extraordinary. Their base pools are extraordinary with Paxos, Dan. Yeah. I mean, what, are they going to get 20-something million dollars a year just by restructuring their liquidity composition? I mean, folks talk about Frax as a stable coin. I mean, FRAX is a stable coin that's collateralized by Treasury. And what is a stable coin? What is a currency unit? What is the point of their protocol? It's not what people think, and I'm trying my best to apply words to define what they're doing. Because if literally at one point I was thinking it's a one-to-one with USDC, and during USDC meltdown, it was pegged to USDC. So that's a problem for the protocol's implementation. Why be pegged to a stablecoin? It should be pegged to a dollar. What is a dollar? A dollar relative, would you really want purchasing power? Oh shit, they're working with FPI as well, and purchasing power in what country? So it's a lot of deep financial questions and equations to consider. Like if you have Frax, if you had just a protocol that took stablecoins, USDC as collateral, and the entire point of your protocol was to acquire protocol on liquidity and wrap it with an incentive system and tokenomics, I mean, that's meaningful unto itself. I always thought that was an interesting concept. And then Frax started maturing and FXS ETH and all this protocol on liquidity, and they're just very powerful. A powerful, powerful entity in the crypto markets with a whole lot of risk exposure and a whole lot of volatility. $14 to $8 was down at $4. And this is a relatively new chart. It's all FXS paired with Frax. Sushi? Maybe there's more history here. There's your history. Let's go out to the monthly. I mean, come on, what a history. $1.90 in 2021. Big accumulation wicks in 22. And the bottom fell out. Good old May 22. Woof! What a blowout in 22. 22 is just, literally, it's just January of 22 is when global liquidity, I mean, you see it in the macro charts. You see it in the dollar. You see it in move, in bond volatility. You see the top. You see when everything, when rates just suck the liquidity out of the system. This was forced selling. 22 was forced selling. Now we have a bit of an organic market, and the crypto markets are just an extremely volatile market, but at least it's somewhat more organic relative to just full-on forced selling. We don't have that anymore. It's not 2022 anymore. Asun, I find that very interesting. Yeah, no, it's very meaningful. The halal section of DeFi Llama. I mean, look what's going on in the United Arab Emirates. Come on, look, it's big. Look what's going on with BRICS. I mean, the dollar's not going anywhere, but they're trying. Look, this is what's going on from a global perspective. They're trying to restructure liquidity, and who has a capacity to manage liquidity and manifest liquidity and encourage, incentivize growth and currency expansion? Who's in control? They're trying to reshape the global currency landscape, so that there's different actors with different levers and different pressures that different countries and central banks can apply. But this will take decades. It will not happen quick. It will happen slow. The amount of dollars that are needed to finance global debt obligations is still extraordinary. So even if more trade is done not in dollars, you still need a shitload of dollars. How many quadrillions? Dollar liabilities are out there, which means how many trillions of dollars are needed to finance various debt obligations. Can you please tell me, what do you think about Arbitrum and I think you mean optimism. I think the old twos are meaningful. ZK off to a very rocky start. I'm not fond of the centralization. I like the way Chris Black thinks from an adversarial perspective. Anyone who is not digesting what he says is just don't be protective. You don't want to support your positions. That's a bias, and that is not in your best interest. You want to be fearful, and you want to mitigate your risks and navigate your fears, and you need to find comfort so you can survive from a time perspective. You're not going to survive in a market 2, 3, 4, 5 years unless you can find comfort. So there's a degree of risk being exposed to Arbitrum and optimism. What kind of risk? Relative to what? Relative to volatility? Relative to adversarial market actors? Relative to multi-sig and centralization risks? I have a little bit of exposure to L2s, and I have a sized exposure to L2s that I'm comfortable with, and it's marginal. And in these market conditions, I probably wouldn't have taken those positions. Those positions were probably taken in 2021, and they were locked, and I can't do anything about it. I probably would have liquidated in 22 to not have that kind of risk exposure, to be more concentrated on the least risky of networks with the guaranteed finality, Mainnet. Hope that helps, Felipe. All right, let's wrap it up for today. Albeit, let's look at two charts to wrap it up, give you perspective. Notice I still look at the DXY on the 6-month chart. So this is going to be one candle, this little candle. We've been looking at it for weeks. There's 2 months left in this one single candle. So you won't see it pushing towards the TWAP on the 6-month for another 2 years. So it's hard for humans to think in multi-month, multi-year time frames. But this chart screams to me over the next 5 years we're going to see dollar depreciation, not necessarily because of organic factors. The organic factor is the dollar is needed to serve as debt obligations. So that's Brent Johnson's ideology that eventually other currencies just begin to fail, their weakness, and they have to buy the dollar because they have to service the debt. So their currency just continues to depreciate, and this is predominantly yen and whole shit show over in Japan. But structurally, either from a policy perspective of the United States or the ECB or the Japanese central bank, they will have to structurally depreciate the dollar to allow the system to have adequate liquidity and liquidity flows such that it's actually functional as an economy, a global economy. Capital flows from country to country, from market to market. If Japan's economy fails, what the fuck? That's not okay for the global system. The amount of what they contribute to global financials is extraordinary. So all these central banks are thinking, yes, relative to themselves, but also relative to the dependence that each central bank has on the function and existence of other banks because of what globalization did. We're all dependent on one another to one degree or another. So you can't, they can't just let everything fall apart for the systemically important infrastructure. And then in this regard, Japan and Europe, obviously the U.S., and those three are systemically critical to the function of the dollar. And the excising of Russia and the isolation of China, the geopolitical tensions there, are bifurcating the global economic system along ideological lines. And it's causing pressures, choices, decisions by countries to change denomination of trade, and that's a big thing. But that stuff requires a chart like this to get a perspective on. Those types of geopolitical changes take years to play out. Check back in 2025. And my job on this stream is to interpret that. All right, check back in 2025, 26, 27, and how does that play into potential choices we can make today? Perspective, that long-term perspective, what it has, the effect it has on the perspective we have of the markets today. And that's not an easy story to tell at all. Sir Joe, opinion on real-world assets that Chico talked about. Chico Crypto, he's been around for a long time. Real-world assets is a big deal. Infancy, regulation, those types of words come to mind. It's just barely getting started. There's that's the antithesis of immutability. I mean, you're literally exposed to some sort of centralized entity that's going to be a record keeper or some sort of arbiter of information. and that's not something I necessarily want exposure to. But is that not a direction, the destination for all collateralization? You want to access the equity in some sort of piece of land, and why go through a centralized banking institution when you could access capital permissionlessly? The permissionlessness of 2020 is what's carrying forward, and it's going to be a significant consideration in the structure of these markets in the next 5 to 10 years. Banking is going to change over the next 5 to 10 years. Nobody wants to be told what to do. Nobody wants to be exposed to the balance sheet of a bank, the subjective choices of the investments of a bank, the risk profile. When you could have something that's completely permissionless, open, on-chain, quantifiable, Dune Analytics dashboard, the composition of these protocols' balance sheets, that changes the entire equation for family offices and risk management teams and departments. What does the risk management team look like when they have an investment in a bank? Hey, John at the bank, what's going on? How's it? Send me some reports. Or in the future, in 3 years, the risk management team for a family office is like, all right, we'll pull up the Dune Analytics dashboard for where we have $50 billion collateralized and we're borrowing $10 billion and we have 5 different businesses on 3 different continents, but all that data is on a Dune dashboard. No person to communicate with, no corresponding risk management department to talk about. Just a public Dune dashboard with endless information. I think that's the bunny dashboard, and this might be the Frax. No, it's bunny. This might be the curved dashboard. It's all public, tremendous amount of endless information. So if that's the future, Sir Joe, it's not the now. It's going to take time for those centralized entities to acclimate to the concept of public databases, public storage of information and records, and they don't if you don't have control over the books, that changes the whole enterprise equation. I don't know. Hey, no, is Vodium still going from last year? Vodium's still around, but Vodium is convex. Yeah, Vodium is convex, of which a lot of us are not necessarily participating as much in. Me personally, I go to the base layer, and that was my choice. And end of 21, 22 was to concentrate in the base layer. And convex is cool. Convex will do what it does, and that's where Frax deploys its capital because of their convex control. So, food for thought. All right, let's wrap it up for today. 33 people still in the stream. I appreciate all of you surviving this bear market. Of course it's a bear market. Of course it's a bear market. Bear bull. Let's go back to what I was telling Dan at the beginning of the stream. Bear and bull will drive you nuts. This is a shitty market, a shitty liquidity condition market. And you can tell by the 1 month and the 3 month T-bills how fucked up this market is. Horrible conditions for the bond market, the collateral market. And it's not going to change. Maybe there'll be a capitulation. So strap in, expect some shit to go down, and focus entirely on surviving these markets. And that's how you'll be exposed to favorable liquidity conditions in the future. Last question, Dan. Any idea why Convex doesn't use hidden hand as well? Well, hidden hand didn't exist when Convex was created. Vodium was the incarnation. Vodium was created for Convex. So that's why. That's just timing. And hidden hand was what, a redacted creation So this is going to be such an interesting market in the next 5, 10 years. It's going to be so damn interesting. There's no other market that's interesting like this. I could just think from logging into a Schwab or a Fidelity. I'm like, what a fucking boring thing. I'm gonna buy some bullshit stock with the bullshit dividend and some bullshit proxy voting, and I'm exposed to the risk of the subjectivity of the board, and I'm exposed to all their capex requirements of human resources and real estate. Eh, this is some interesting stuff. That is not interesting in my opinion. 30 people left, 11 likes. Hit that thumbs up button. Thank you all very much. Monday, April 24th at 12:36 p.m. As always, thank you all for joining. Tell everyone to subscribe. After party on Discord for the most rational community in the entire crypto space. I will see you next time. Peace.